The seed. Walk into any bookstore, find the personal finance section, and count how many books are about getting rich. Now count how many are about the moment most people never reach, the night they keep their first $100. Almost zero. The whole industry skips the part that actually decides everything. Here's the truth: nobody puts on a book cover. Wealth doesn't start when you make money, it starts the first time you don't spend it. That's the whole game's first move. Think about what's happening when you get paid. The cash hits the account, and within milliseconds, your nervous system starts assigning it. Rent here, food there, the thing you've been wanting, the bill you've been dodging. By the time you finish the math, every dollar already has a destination, and none of those destinations are you. That's not a budgeting problem, it's a default operating system. Money flows through you in a current, and unless you build something to interrupt that current, it'll keep flowing for 40 years and leave you exactly where it found you. The seed is the interruption, the first $100 you let sit, not invest cleverly, just sit, untouched. Because what you're doing isn't financial, it's neurological. You're proving to yourself that money can stop, that you have a switch in your hand the world's been telling you doesn't exist. And here's the part that flips people. The amount is irrelevant. $100, 50, 10. The actual sum could not matter less. What matters is the act, repeated. Compound interest doesn't compound on dollars first, it compounds on the habit of keeping them. You can't build a fire without a spark, and the spark is small on purpose. The trap is thinking you need to wait until you have more. You won't. There's no income level at which spending magically gets easier to control. Ask anyone making 300 grand a year who can't keep 10%. The discipline doesn't show up later. You build it now or you don't build it at all. But a seed by itself isn't capital, it's potential. The next stage is where it starts becoming something with weight. The stack. Okay, so you've got a seed. Now what? Most people get this part dangerously wrong because they confuse two things that look identical from the outside but behave like complete opposites under pressure. A stack is not an investment. A stack is dry powder, liquid, boring, sitting there cash. In a financial culture obsessed with making every dollar work, the stack gets dismissed as lazy money, but it's not lazy. It's loaded. A weapon waiting for the right moment, and most people who skip this stage end up paying for the lesson with interest. The math is brutal. Without a real cash buffer, every emergency in your life, and there will be emergencies, gets paid for with debt. Car blows a head gasket, that's $3 grand on a credit card at 23%. A C dies in August, another $2 grand. Job goes sideways for 3 months, that's your savings drained at the worst possible time. A single bad year without a stack can erase 5 years of progress. The number you're aiming for isn't arbitrary. 3 to 6 months of total expenses parked in a high-yield savings account currently paying around 4 to 5%. That's not investing, it's positioning. You're not trying to grow this money. You're making sure nothing else gets crushed when life does its thing. And the second you have it, your entire risk tolerance changes because you can finally afford to take risks elsewhere without your whole life riding on the outcome. Here's the part that separates people who actually build capital from people who talk about it. The stack is the foundation under everything that comes next. You can't take a calculated bet on a startup, a stock, a real estate deal, a career pivot without a buffer underneath you. Every legitimate risk in finance assumes you can afford to lose. The stack is what makes you affordable to lose. Without it, you're not investing. You're gambling with rent money, and the casino always wins eventually. Once that buffer's locked in, your relationship with money quietly mutates. You stop reacting to your account balance like a heart monitor. You start to feel something broke people never feel: patience. And patience is the actual currency of every stage that comes after this one. But cash that just sits is leaking value to inflation every day. The next stage is where money stops sitting and starts doing. The engine. You ever watch someone push a car uphill versus someone driving one uphill? Same hill, same destination. Wildly different experience. That's the difference between every stage before this one and every stage after. The engine is the moment your money starts producing money on its own. The first time you take a chunk of capital and convert it from a static thing into a generating thing. Before the engine, every dollar you have was earned with time. After the engine, dollars start arriving without trading time for them. And that asymmetry, repeated over years, is what actually builds wealth. The classic engine for most people is a low-cost broad market index fund. The S&P 500 has averaged roughly 10% annual returns over the last century, around 7% after inflation. Park $10,000 in there, walk away, and in 30 years it's roughly 76,000. You did nothing. The engine ran the entire time. Here's what's actually happening under the hood. When you buy an index fund, you're owning tiny slices of hundreds of companies: Apple, Microsoft, JP Morgan, all of them. Those companies are out there hiring engineers, opening factories, selling products in 80 countries, generating profits 24 hours a day. A fraction of those profits flows back to shareholders through stock appreciation and dividends. You're not picking winners. You're owning the entire economic engine of the developed world. The mindset flip at this stage matters more than the money. At every previous stage, you were thinking in income: how much do I make per hour? At the engine stage, you start thinking in assets: how much do I own? The question that lives in your head changes from what does this cost to what does this produce? A $40,000 SUV produces nothing except depreciation. 40,000 in an index fund produces roughly 4 grand a year in expected returns, indefinitely. Same dollars, two completely different futures, and the gap widens every year. The mistake at this stage is overthinking it. People stall here for years trying to pick the perfect stock, time the perfect entry, find the secret fund. None of that matters. Just start the engine. Pick boring, broad, cheap, and automatic. Set the contributions to pull every payday before your brain registers the money exists. But one engine is fragile. The next stage is where you stop running on a single cylinder. The multiplier. Here's a question worth sitting with. What do almost every wealthy person you've heard of and almost every person who lost everything in 2008 have in common? They both bet too hard on one thing. The wealthy ones got lucky, the wiped out ones didn't. Survivorship bias makes the first group look like geniuses and the second group invisible. Don't let that lie shape your strategy. The multiplier is the stage where you stop having an engine and start having an engine room. Multiple income-producing assets, structurally different, behaving differently under different economic conditions. This isn't about being clever, it's about being durable. Because no matter how good a single asset looks today, you don't actually know what's going to happen to it over 30 years. A real multiplier portfolio usually has stocks, bonds, real estate, sometimes private equity, sometimes a small business stake. The diversification across asset classes does the work. When stocks crater, bonds usually hold. When inflation runs hot, real assets tend to outperform. When the economy panics, cash and gold get a moment. You're not trying to win every year. You're making sure no single year can wipe you out. This is where capital starts behaving differently than just savings. You're no longer the only one working. Your real estate is collecting rent. Your bonds are paying interest. Your stocks are throwing off dividends. Each one runs on its own schedule, and critically, the streams aren't correlated, which means when one zigs, another's usually zagging. The volatility of the whole portfolio drops while the long-term return barely moves. That's not magic. That's diversification doing what it was always going to do. The mental shift is subtle but huge. You stop watching individual investments like a sports fan watching a game. The minute-to-minute drama becomes irrelevant because the system is what's working, not the parts. You check the portfolio quarterly, maybe annually. You rebalance, you adjust the allocation as you age, and you go live your life. The capital is doing the heavy lifting now, not the spreadsheet. So you've got a system, multiple streams, compounding quietly across asset classes. But none of those streams are big enough yet to actually live on. The next stage is where that math finally tips. The cash flow. Here's a number that should mess with your head. The average American household spends roughly $6,000 a month. That means if you had a portfolio throwing off $6,000 a month in pure passive income, you would never need to work another day in your life. Not in a fancy way, just freely. And the math to get there isn't science fiction. It's just consistent capital deployment over time. The cash flow stage is the moment your assets generate more income than your lifestyle requires. Not in a good year. Reliably, month over month, in the kind of way that makes the question, what if I lost my job, feel weird because the job is already optional. This is where capital stops being a savings account and starts being a private payroll department running in your name. The standard math here is the 4% rule. Roughly speaking, if you have 25 times your annual expenses invested across a diversified portfolio, you can withdraw 4% a year and statistically the portfolio will last indefinitely. Spend $40,000 a year, you need $1 million invested. Spend $100 grand, $2.5 million. Sounds insurmountable until you actually run compound interest projections on someone earning median income, saving 20% a year starting at 25. They hit it in their early 40s without any luck or genius, just discipline plus time. What changes at this stage isn't really the money, it's the relationship to time. Hours stop being something you sell and become something you spend. Every commitment in your calendar gets reevaluated through a different filter. Not, can I afford to skip this, but do I actually want to be here? Most people never get this filter installed in their lifetime. Imagine taking off a backpack you didn't realize you'd been wearing for 20 years. That's roughly what hitting cash flow feels like. But here's where ego gets weird. The cash flow stage is where people quietly inflate. The income is comfortable, so the lifestyle expands to match it. New house, better car, private school, the kind of choices that feel earned and probably are. But every dollar you spend at this stage is a dollar that's not compounding into the next one. The people who treat cash flow as a finish line tend to plateau here forever, which is fine if that's what you want. But there's a stage past this where the math gets genuinely strange. The compounder. Most people understand compound interest the way most people understand gravity. They know it exists, they don't really feel it until they fall off something. Then it gets very real, very fast. The compounder stage is the moment compound interest stops being a concept and starts being a force you actually have to manage. Here's what's happening mathematically. Once your portfolio crosses a certain threshold, roughly 5 to 10 million invested depending on your spending, annual returns start exceeding annual spending by a wider margin every year. At 7% real returns, 10 million produces roughly 700,000 a year. If you spend 300 grand, the other 400 just compounds back into the principal. Next year, the principal is bigger. The 7% return is bigger in absolute terms. The gap widens, the compounding accelerates against itself, and what looked like a steady climb becomes an exponential curve you can't outrun even if you wanted to. This is where snowballs become avalanches, and the metaphor isn't flattering accidentally. Avalanches are fast, hard to stop, and mostly out of your hands once they're moving. The compounder runs the same way. You don't really decide to get richer at this stage. The system just does it, whether you're paying attention or not. The capital has its own momentum. Your role shifts from operator to caretaker. You're not building anymore, you're stewarding. And the mindset shift here is the strangest one in this whole journey. At every previous stage, you were optimizing for yourself, your security, your freedom, your lifestyle. At the compounder, the optimization horizon has to extend beyond you because the math will outlive you regardless. You start thinking in decades and generations, endowments, foundations, trusts that operate for 50 years after you're dead, family offices. Money quietly converts from a personal asset into something more like a force of nature you've decided to point in a particular direction. And I'll be honest with you, this is where things get psychologically complicated. The compounder takes survival completely off the table, which sounds great until you realize that survival has been the engine of human motivation for 200,000 years. Without it, motivation gets weird. Some people get bored, some get destructive. Some develop strange obsessions with metrics and scoreboards because they need something to want. The wealthy ones who do this stage well build deliberate structure around purpose. Projects, philanthropy, art, mentorship. Anything that gives the day's meaning the bank account no longer can, because the next stage isn't really about money at all, and the people who reach it usually don't fit the profile you'd expect. The machine. Strange thing happens at the very top of capital accumulation. The capital stops needing you. It runs independently of any decision you make, any input you provide, any attention you pay to it. And at that point, the entire question changes from how do I build it to what do I want it to do? The machine is capital that has become self-perpetuating across generations and institutions. The kind of structures the Rockefellers built, the Carnegies, the Buffetts. Capital that stopped being a personal fortune and became a system. Foundations that operate for 100 years. University endowments that fund research nobody else will. Family offices that span 4 generations. The principal grows faster than any reasonable distribution policy can spend it down, and the institution itself becomes immortal in a way the human who started it never could. What's wild is that money at this scale stops being interesting. The actual numbers become absurd to the point of meaninglessness. What's the practical difference between 2 billion and 4 billion to one person's life? Nothing. The lifestyle ceiling for a single human got hit somewhere around the cash flow stage. Everything past that is theoretical. So the question that occupies the people running these machines isn't how do I get more, But what is this for? And that question, it turns out, is way harder than the financial one. A lot of people at this level get it spectacularly wrong. They fund vanity projects, they put their name on buildings, they spin up foundations that mostly exist to pay their friends' kids and throw galas. The money becomes a scoreboard with no other players, and scoreboards get hollow fast. The ones who get it right tend to focus on areas that are unglamorous, underfunded, and high leverage: public health in places nobody's covering, scientific research with payoff horizons too long for normal markets, education in regions the spotlight ignores. The math of impact is the same as the math of investing. Find the asymmetric bets, avoid the obvious, crowded trades, and here's the twist nobody mentions. The machine isn't actually about money at the end. It's about whether anything you touch changed the trajectory of something larger than yourself. Which means, and this is the uncomfortable part, you don't necessarily need $1 billion to build a machine. Teachers who shape entire generations of thinkers built machines. Scientists whose research rewires how a whole field operates built machines. Writers whose ideas keep getting cited 200 years after they're dead built machines. The financial machine is just one variant, probably not even the most reliable one, honestly. So zoom all the way out. The 7 stages aren't really a wealth ladder. They're a sequence of relationships with capital, each one demanding a different version of you. The seed is about discipline. The stack is about patience. The engine is about courage. The multiplier is about humility. The cash flow is about restraint. The compounder is about purpose. And the machine is about meaning. Most people spend their entire lives stuck somewhere between seed and stack, and they don't even realize there's a whole architecture above them. If this rewired anything in how you think about money, drop a follow. There's more coming. And I want to know honestly in the comments, which stage are you actually at right now? Not the one you're chasing, the one you're standing on. I read every reply.